Hello and welcome to the Academy. Now, recently, a few inquiries have come across my desk here at the Academy talking about something called VAR. Now, I must admit, given the timing of this recording, and those of you with an eye on European football will understand, I had to do a bit of a double check to make sure we're all using the same version of the abbreviation. We're talking here of VAR value at risk. It's an estimate of the worst expected loss on a portfolio of instruments resulting from market movements over a given time horizon and a predetermined confidence level. Now, in the past, this was a discussion typically reserved for the banks and financial institutions in the realms of regulatory capital, but now more increasingly, it's entered the mind of retail traders and investors. We see more and more brokers offering methodologies and assistance and giving this functionality on their platforms. So hopefully, to answer a few of those questions pitched to me, and again, I'll try not to be too mathsy, easier said than done in this area, I'll offer this brief session to discuss value at risk, and of course, its many limitations. Now, once again, you'll be able to access the Excel spreadsheet that I'm going to be using via the link supplied, and you can play around for yourself with these concepts. Now, if you already know these concepts, of course, this isn't for you, but for everyone else, let's break it down. I'm going to do this in two parts. Welcome to part one. So the concepts we're going to discuss in this session go all the way back to German mathematician, astronomer, and all-round very clever guy, Carl Friedrich Gauss, and something called Gaussian distribution. Gaussian distribution, commonly and these days very mistakenly referred to as normal distribution, lies at the very heart of modern finance, especially risk management and financial modeling. Now, whilst this idea may have some legs for naturally occurring phenomena like the average height or weight of children at certain ages, in the world of finance, there's nothing typically normal about it. And what is often forgotten is Gauss originally intended the normal distribution to be as a test of error, not accuracy. But anyway, enough of that. Let's get back to the matter at hand. The key characteristics of what we'll, for the sake of it, carry on calling normal distribution can be described by two numbers. The mean, or average, or central tendency. Here we're using the simple arithmetic mean, and variance, or standard deviation. That's a measure of dispersion around that central tendency. And modern finance is fixated by these two numbers, especially variance or standard deviation, which are seen to be synonymous with risk. It measures the size and speed of price changes, and the larger those changes in price, the higher the risk we're assuming. So what we're going to do is start with a very basic example here, where we have the monthly returns to a stock over the previous year. So quite a small sample. We haven't got a population of data here. We've just got the sample. So we're going to have to make some adjustments as we go along to deal with that situation. So with these returns, we need to work out the simple arithmetic mean. So even without a mathematical background, you'll know this. We'd simply add all of those returns together. We take the sum of those returns and divide it by the number of pieces of data we have there, which in this example is 12. And that's going to give us our simple arithmetic mean. We now need to take it further and we need to work out our standard deviation, or to be quite precise, our sample standard deviation. And you can see the various stages of the calculation that we're going to be doing very shortly on Excel. So what we're doing is measuring the variability of the data set around that mean, and we're looking at the average difference of each of these values from that mean value. And this is how we're going to do it. So the first stage, we take the sum of all of those differences between each value and the mean. So all of those observations, we're going to deduct that mean to see those differences. Once we have those differences, we cannot simply add them all up together and try and do the same kind of simple average calculation that we've just done, because it's not going to work. Because we're going to have negative values and we're going to have positive values. Some of these numbers, some of these observations will be below the mean, as in negative. Some of them will be above the mean, so positive. So by simply trying to add them all up together, we'd actually get back to zero, because that's the essence of the mean. It's not going to work. So what we need to do, and this is the second stage here, we're going to square those differences to remove those negative values. Okay, so we're going to turn those negative values into positive ones. And that's by just simply squaring those differences. Then once we've done that, we'll take the sum of those squared differences And we're going to divide it not simply by the number of pieces of data as in 12 in our example. Now, what we're going to use is something called Bessel's correction. We're recognizing we have a sample here. So by using n minus 1, we're going to make the spread or deviation just a little larger to reflect the fact that we've got that sample, we haven't got the entire population. It's not going to be perfect, but it's going to look better than just simply trying to work on a sample. We recognize, it's a small sample. It's not giving us the full picture. I mean, we'd much rather have the entire population of data if we could get hold of it. But what we're going to do is make that slight tweak to this to get closer to what it would look like. Okay, so we're going to do that Bessel's correction because we're dealing with a sample. So instead of just divided by n, as in the number of pieces of data, 12, we're going to do n minus 1. So that, of course, means we're dividing by 11 in this example. And that will make that deviation just a little larger. Okay, the smaller the sample we have, the more this adjustment would be, the more we'll be adjusting the results. Okay, and that's this Bessel's correction. So as the sample gets smaller, then the adjustment gets bigger, and you can kind of figure that out, I guess, within your own minds. Now, what we've got in that third stage when we do this is we've got the variance, but we've got the sample variance. What we need to get to is the sample standard deviation. So the last part of the calculation is simply to take the square root of that result. And what this is going to do is counterbalance the squaring that we did in stage 2. In that second step, where we squared the differences, well, we're now coming backwards, we're taking the square root, and that's going to counterbalance that squaring. And that will give us our sample standard deviation. So that's the long-handed way of viewing it. You don't need all of this. I'm going to show you how we do it on Excel, and I'll take you through this very example now. So here we have it on the Excel spreadsheet. We've got our monthly returns. You can see that in column B there. And we're simply taking the sum of those and dividing it by the number of pieces of data here, which is, of course, the 12 months. And that's what we got there. That is what we're calling, in this example, X bar. That's how we describe that. We would use the symbol for mu if we had the full population, but we don't. It's a sample. So just to get that out of the way, and that is your simple arithmetic mean. And you can see the formula obviously there in terms of what we use on Excel. We just take the average of what we have in that column. Then the second stage, as you saw on the previous slide, we're going to take the differences. We're going to look for those differences. So if you look at that first observation there, the observation is 1. Now, I'm not using percentages here on this Excel spreadsheet. Of course, it is a percent, but I'm just making it nice and simple, very, very basic. Just to begin with, we'll rev things up a little bit later, but I'm just taking that observation as a number, and I'm saying, right, okay, knowing that the mean is 1.17, then 1 is, of course, 0.17 below the mean. And you can see that difference right there. And indeed, you can see all of the differences in that column. Now, as I suggested to you moments ago, we cannot simply take the sum of those differences because we will get straight back to 0 because we have positives and we have negatives. And we've already mentioned that, what the rationale behind that. So what we suggested we would do is take these differences and simply square them. And then we've got these new results in this column here. So you have those squared differences there. And if we take the sum of that, you can see obviously the number's quite large there, 111.67, quite a large number. And then what we do, again, if you look back at the previous slide, what we're going to do is we're going to divide that by the number of pieces of data, as in 12 minus 1. And that will take us to the sample variance. Okay, and again, you can see the formula. We're taking that sum of all those square differences, and we're going to divide it, in this case, by 11. And that gives us our sample variance. That's the average of the square differences from the mean. All right. And then just one last stage to take it to what we're really looking for here. In this example is the standard deviation, the sample standard deviation. We just take the square root. So we just take that variance and we take the square root of it. In this example, all we're doing is taking the variance to the power of 0.5, as in the square root. Okay, so nice and straightforward. Now, just ignore what we've got going on the right-hand side. You can come back to that later when we go through all of the other points that we need to get through this situation, this session on VAR. Okay, but I'll leave you with this last point just for this sheet for a moment, the Z-score. So what is the Z-score? Well, the Z-score in simple terms is just how many standard deviations we are from the mean, either plus or minus, and that's the Z-scores that you're seeing in this column just here. Okay, and you can see how the formula works and how we're getting to these Z-scores or Z-scores, of course, if you're watching for the United States. And you can see the formula just at the top there. Okay, so what we're taking is those individual observations, we're deducting the mean, and we're dividing the results by the standard deviation, which we've calculated right there at the bottom. Okay, now what we're going to do in a few moments' time, and then further into part 2, is we're going to go into talking about confidence levels and talking about, of course, value at risk and how we're going to use, obviously, the calculation that we see here to get to the results we're looking for. Okay, but hold your horses on that for a moment. We will be coming back to this spreadsheet very, very shortly. But in the meantime, consider this. If we're going to calculate a VAR number for multiple assets, so a portfolio VAR, if you will, then this is going to rely on us looking at the relationship of price changes between all of these different assets in our portfolio. So, for example, if shares in London moved up by 1% and shares in Frankfurt moved by, say, 0.8%, so 80% of the London move, then this is where we're going next into what we call covariance or correlation. And VAR relies on risk managers being able to model these relationships accurately amongst sometimes hundreds of different assets. Now, we don't have to do that. We're going to just keep it simple. We're going to go into an example with just 2 assets. But we're going to build on this by going through, firstly, correlation and then covariance. So starting with correlation first. Correlation describes the strength and direction of a relationship between 2 variables. And in terms of magnitude, we're talking about a range anywhere from -1 to +1. Values that increase or decrease together are considered to be positively correlated, and values that diverge are considered to be negatively correlated. And when you hear the term perfect correlation, that's describing literally a one-for-one relationship. So if we're talking about the positive correlation, if we're saying that one variable moves up by 1, let's say, and the other moves up exactly by 1, that's a perfect one-for-one relationship. That's what we'd call perfect positive correlation. So that would have that +1 as the measure here. All right, and if we have something that's one variable moves up by 1, the other moves down by 1, and of course that's perfect negative correlation. And if you see a correlation of 0, well, there's no relationship. This is correlation. This is co-relationships. And a correlation of 0 just says, well, they're not connected. They're not related. So no relationship between the variables. Now, all of this, of course, we put into a measure, and we call this the correlation coefficient. And it's a measure of how closely these 2 variables are. Okay, and how we do this, and we're going to do this very simply on Excel in a moment, we take our covariance. So that's where we're going to go next, into covariance. We take the covariance between, say, 2 variables, and then we divide that by the standard deviation of the first variable multiplied by the standard deviation of the second variable. All right, but again, leave the formula aside. We're not going to get too mathsy, as I promised, and we'll have a look at this in the Excel spreadsheet very shortly. So moving on to covariance, where we've just seen that correlation is when the change in one variable results in the change of the other. With our covariance, it measures how 2 variables change together, as in tandem. So covariance is nothing but a measure of correlation. Covariance indicates the direction of the linear relationship between 2 variables, or the variables, whereas correlation, as we've just seen and just spoken about, measures both the strength and the direction of the linear relationship between those 2 variables. Okay, once again, lovely formulas down there for population data, sample data, but let's keep it simple. Let's have a look at the Excel spreadsheet. Okay, so we're back to the spreadsheet now, and you can see the first example that we introduced in the early part of the spreadsheet. We've got variable X here with its returns. And again, we've got 12 months of returns there. Remember what we did, we worked out our mean, our average, our simple arithmetic mean. And that's what we did in that first tab, the introduction tab. And you know the process we went through, we looked for the differences between the observations and the mean. And then we said to ourselves, well, we couldn't actually simply add those up together to work out an average of those differences because of the signage problem. So what did we do? We squared the differences, and that got rid of the negative signs, and then we could add them up. And of course, that took us all into working out our variance and our standard deviation. So we've done that in the first tab. Now what we've introduced is another variable. This is going to be variable y, and we've done the same process. So here we have the returns. We have the returns for variable y in column F there. What we do is the same thing. We're looking at the differences, but of course we still have the signage problem there. So what we need to do is to square those differences, and that will remove the signage problem. And then working out from that our variance and standard deviation. So what we're looking for, again, is this relationship between these two variables. And if you just eyeball the numbers, if you just look at those numbers, you can see that they are correlated. They are related, because you see for the first month, variable X goes up by 1% and variable Y goes up by 3%. So there's a kind of positive relation there. If we go to the second month, variable X is down 3% and variable Y is down 1%. So there is some kind of relationship going on there. Whether it's a perfect relationship, well, let's go and examine that right now. So what we'll do, and we're looking here at column E, we're going to take those differences. So the differences between the observation and the mean of X and the observation and the mean of Y, and we're going to multiply those two together. So this time we're taking those differences, not squaring them at the moment, we're multiplying them all together. And that brings us to, of course, this number that we see at the bottom of column E. All right. Now, to get our sample covariance from that, well, we know the method. We've already done the method. What we'll need to do is just to take that number and divide it by the amount of data we have here. So 12 months of data, but we're going to use Bessel's correction again. So we do -1. And that's what gives us that sample variance of plus 7.98. But really, when we're trying to examine these relationships, we want to get back to that situation where the magnitude is anywhere between -1 and +1. So what we'll need to do is normalize that sample covariance number. And that's what we're doing here, just below, when we're talking about this correlation coefficient. And you know what we're doing. We've seen the formula. You can see the formula below here on the Excel spreadsheet as well. But that's what we're doing. We're taking that sample covariance number, that positive 7.98, and we're dividing it by the standard deviation of X, that's 3.1861, multiplied by the standard deviation of Y, that's on the right-hand side, 2.744, and that's what gives us this correlation coefficient. So we can finish by saying, yes, it is a positive relationship. We can see that. It's not quite perfect, but it's very close. It is very close. And that is your correlation coefficient. Okay, so we've gone through the basics here, and these are very much the basics. If you already know, as I said in the beginning, if you already know this stuff, this is really basic to you. This is for people that haven't got that familiarity with this particular subject, but hopefully it's now becoming a bit more familiar. We've gone through the basics. We're coming to the conclusion of part 1. In part 2, as promised, I'm going to jazz things up a little bit. But as I do that, as we go into the various methods of calculating VAR, I'm hoping, because we've done this basic exercise here, a lot of it will suddenly become very, very familiar, even if you've never met this before. But I will see you in part 2.